Well, the large percentage invested in emerging market companies has caused considerable pain for the Sanlam Global Best Ideas and Sanlam Global Financial Funds. The head of Sanlam Investment Management Global, Koki Koiman, joins us now to discuss the impact emerging market exposure has had on the funds. But before we go there, Koki, we're very lucky to have you in the Johannesburg studio. You've been at the Joburg Indaba, which has been primarily focused on mining. Is there a relatively good sense on the ground that the worst is behind us on the mining front?
No.
Now that's just killed the conversation any further. So what are your thoughts? Are we still really in the deepest woods here?
Look, I mean, it depends on two things. Obviously, global growth. So you need global growth to grow stronger. And at the moment, you know, the US and Europe are still mediocre. Japan is, what is it, a bug waiting for a windshield. And China is still slowing down. I mean, I don't know if you saw the Chinese bank results recently, bad debts dramatically up, you're talking 80% coming from a low base. China is going to slow down, so you can't really see resource prices picking up shortly. I mean, the longer term picture for resources is good, palladium and you know, rhodium, etc. But short term, and then the big problem is, unfortunately, I had to say that in my presentation, that the government is not playing ball. You know, you've got very expensive labour, and you've got electricity tariffs going up. Mining's becoming more and more costly, and you're not giving them any certainty. And what worries me most, and sorry, I learned a lot from the falls and the pain we suffered in emerging markets. We're going the road of Brazil and of India, where government is becoming more and more interventionist and more not allowing the capital markets and private business to make its decisions.
Koki, it's Lindsay in Cape Town. I'm reading your report here, and this is a rare attack of candour from the financial services industry. Let me read you a couple of sentences here, and this is your words, by the way. Our investment in emerging markets, when measured against the developed market weighted MSCI World Index, makes us look bad. You don't look bad. Did we make poor judgments? You go on to say. The short answer is yes. Now, what I'm going to ask you here about the Sanlam Global Financial Fund is it a good idea but wrong timing? Is it as simple as that? In other words, in the long term it's going to do well, but in the short term you have to be honest with yourselves.
Look, the thing was triggered by the sudden talk of the QE ending, and that triggered a flight of capital out of emerging markets, and that caused currencies to fall dramatically, and with that equity markets. So that is what we did misread. The long-term picture in emerging markets is not as good as it was, because I think it's undoubtedly, and we've been fighting it in South Africa, but interest rates in emerging markets will have to go up. So yes, what has happened, and we've been using the weakness to buy quality in emerging markets like Itaú, Banco do Brazil, Yes Bank in India, you know, prices halved and your currencies fell 15%. So yes, I thought it was a very good time to buy, and in fact we, in the financial fund, we increased our positions. But the timing was wrong. We should have seen it coming, and we didn't.
Koki, you know, when you look, you've got a very wide footprint. You talk to hundreds of people around the whole globe. Two quick questions. First question, what do you see the perception is of South Africa, not so much as an equity or a bond investment destination, but as a true long-term capital investment destination? And then secondly, I mean, we had terrible years for the South African market in dollar terms in the mid-90s and the late 90s. Then we had 10 years of fantastic return in dollar terms. Where to now? What's the valuation, in your view, between our markets and other major developed markets?
I mean, firstly, just point out, I looked again at Standard Bank. Standard Bank, since 1st of January 1980, has done a compound return of about 19%. The last few years it fell off the banner. So, and if you think of what South Africa's gone through in those years, it's amazing. But the valuations are now different. Banks are, I think, fairly expensive, as is the rest of our market. When I look at what foreign investors are telling me, South Africa is their favourite short.
South Africa is their favourite short?
Yep. It's the market they like to short. It's too expensive, whilst the fundamentals are deteriorating, and your government has got an election next year, and it's refusing to do what needs to be done. India is in exactly the same position. It's deteriorating. The government there is still trying a bit, but they don't want to do too many things because they might lose the next election. So you're postponing a lot of inevitable things.
Is it government intervention that is now causing you to look at emerging markets in a negative light? And is it going to change your investment stance?
Yeah, there are two other things, and it comes back to commodities. We mustn't forget that emerging markets were driven by two things. The one is big export volumes. Their clients' growth rates have all slowed down dramatically. So you haven't got that export drive anymore. Secondly, because of US interest rates having been so low and global interest rates being so low, everybody in emerging markets got used to very low interest rates, and which spurred consumption. And it resulted, especially in South Africa, in very high indebtedness. And it resulted in current account deficits. So you've got to do one or two things. You've got to either hike interest rates to reduce consumption, to get your current account deficit right, or you're going to let your currency go. And there's no in between. Emerging markets have had a very good ride, and a lot of them, and we included, did not use the golden window to really get our house in order.
Koki, what happens if the US eventually starts to taper? Some people are saying, people like Mark Farber are saying they're not going to taper ever, it's going to go on ad infinitum. But when they do eventually, under the stewardship of Janet Yellen in the United States of America, start to taper the quantitative easing, it's going to be quite a momentous event. It's going to be psychological. It's also going to be material. Do you then run for the hills with emerging markets? And if you do run for the hills, which hills do you run for? Do you say to yourself, well, I'm going to get rid of emerging markets for a long time now? Or do you say to yourself, there are emerging markets and there are emerging markets. Some will be more defensive than others, because it's a big conundrum for you fund managers next year probably.
Yeah, no, Lindsay, you're totally right. The end of quantitative easing or tapering has just been postponed, and so it's bought emerging markets time, and that's why it's so frustrating that with these elections, because the guys should be taking action now. Some of them are. When Brazil has hiked interest rates a few times, India again hiked interest rates today, Indonesia has been very proactive, but so the positive in all of this is that your oil and gas exploration in the US is going to spur growth. So the US is not going to fall over, and it could actually accelerate. As the US starts growing, it could pull emerging market exports again. So it's not all fall down, but I think more importantly, most emerging market investors have had their fright, they've pulled out. So, the big dislocation is over. I think you're going to see further weakness, but the hot money, a lot of it is out.
All right, so now let's look to the positive, the bright spots as you see it now from an investment perspective. Let's look at geographies.
Yeah.
I hope there's some, Koki.
There are a few. Funny enough, the ones where we did invest in Brazil a few months ago when that had fallen quite a lot, but Brazil has actually recovered quite nicely, and the real as well. India is still quite cheap, but India, you've still got a big problem with what is the government going to do in the election. But what we're selectively nibbling in India, Russia is actually very cheap. Russia is very hated, but Sberbank in Russia, biggest bank in amongst emerging markets, very cheap, very good track record. So but then surprisingly, where we have started buying is in the US. If you look at Citigroup, you look at Bank of America, you look at even JP Morgan, well, that's trading on 1.1 times price to book, but the others are trading at a 20% discount. Barclays, Deutsche Bank are trading at a 20% discount to their net asset value. And a lot of the write-offs have taken place. You've seen huge penalties, that have been paid. So, I think that's really where the value is. Funny enough, more now in the developed markets a bit and the emerging markets. We're just really trying to pick individual spots.
There's been an enormous amount of dislocation between the various markets and the various asset classes and the various sectors within those asset classes, Corky. We're talking about Google and Facebook and Apple results out this morning. When the Apple results came out, everyone says, well, they've actually beaten, but then it was still lower than last year. And there's all sorts of confusion going on. Is there a case that to be made for the fact that there are geographies that are doing better than other geographies and sectors that are doing other things from other sectors, and therefore you have to be, as we always say on this show, a stock picker or a sector picker or a geographical picker? Is it as simple as that?
When you say those words, is it as simple as that? You know, but what you're saying
Very
is true.
simple.
There are sectors that are still mispriced, and a lot of the financials globally are still think mispriced. But if you look at the tech sector, the large cap tech shares are still very mispriced. And you look at our Best Ideas Fund, you know, it's come back very nicely in the last few months since I wrote that letter, that very candid letter. And like Microsoft yesterday, was it the day before yesterday, up 6.5%, very good results. If you look at Samsung, it's in Korea. It's actually got nothing to do with Korea except that it's located there, but its share price seems to be driven by the Korean market. Samsung is on a P of 6.5. It's much better company than Apple, I think. It's much more diversified. So yes, you've got to look at not only where a company is, but where its markets are and what its moat is.